in-house banking and netting are a must for today's global treasury. Today, this webinar will be presented by Kyriba and Actualize Consulting. So before we begin the webinar, let's talk through some of our house rules. Next slide, please. During the webinar, all attendees will be placed in a listen-only mode. However, please submit your questions at any time during the webinar. All you have to do is go to the gray Go to Webinar box, typically on the right-hand side of your screen, and type in your question. As we get to a natural break through the flow, we'll go ahead and we'll look at answering those questions. Although for the sake of time, we typically do tend to move it towards the end of the webinar to give everyone enough time to review all of the content. If you encounter any technical issues during the webinar, please go ahead and call the GoToWebinar support team at 1-888-259-8414. If you have any additional questions or concerns, or if you have been able to hear us and then lose the sound, go ahead and enter those same questions into the gray GoToWebinar box. This particular webinar today does offer CTP accreditation, and you'll receive the approval letters within 3 to 5 business days. And these letters are sent to all of the full session attendees. We are recording today's webinar, and both the link to the recorded webinar and slides will be emailed, and they'll be posted on Kyriba. Don't worry about trying to write down that link. You'll actually get that in the email a little bit later on here. So let's look at today's presenters.
Thank you, Tracy.
Thanks, Greg.
So good afternoon, good morning, everyone. Thank you for joining today's webinar presentation. My name is Greg Person. I'm the Vice President of Global Pre-Sales here at Kyriba. I will be going through the presentation here today with Jason. Very briefly on who I am at Kyriba. I've been with Kyriba in this role within pre-sales for the last 2.5 years, but I joined from a corporate treasury background, and in that role I manage in-house banks and global netting programs prior to my role here at Kyriba. Jason, would you like to introduce yourself, please?
Yes, my name is Jason Dobbs. I work for Actualize Consulting. Actualize is a boutique consulting firm that focuses on treasury and capital markets, targeting enhancing operations and technology. I've also come from a practitioner background working in international treasury, and my work in there was really centered around finding a lot of large-scale solutions to help manage our.
So for today's presentation, we're going to discuss a lot of topics around cash management structures, in-house banking structures, and netting programs. What we thought is a sort of a framework or an agenda for today's session. We're going to start with Jason. He'll go through some background here around the goals and objectives of various in-house bank structures, and also explore a number of the elements that are involved within an in-house bank. Also, we'll spend some time discussing some of the work that's involved within an organization to design, to collaborate internally with the various stakeholders and key players, as we'll call them, as we decide to implement and design and launch an in-house bank structure. From there, we'll also move in and have some discussion and presentation around a multi-lateral netting program and some of the consideration and benefits of implementing a netting program. We'll go through some examples there as well, and also talk about the work involved from a collaboration and design perspective, and also introduce some of the concepts around technology, how technology can help facilitate and really evolve these programs. Towards the end, we'll summarize with some benefits. Okay. Before I hand it over, though, to Jason to go through those first few sections of today's session, a few questions here just to get everyone's wheels turning, and a couple of questions to reflect on. Given your respective roles within your companies, whether that be in treasury or whether that be in an accounting capacity, so hopefully these are going to be good questions to ask yourself and reflect on as we go through today's material. They include things such as, do you have insight into your corporate liquidity, your corporate cash? We're going to spend time going through how to mobilize cash and the benefits of an in-house bank. But I guess first and foremost, within your organization, do you have that visibility into those corporate liquidity positions and balances? Do your subsidiaries, whether it be corporate subsidiaries here domestically or international subsidiaries, do they have ample liquidity to be successful and to run their businesses? Or are they holding too much cash or too much liquidity? And is there associated risk and cost with that? From an intercompany perspective, are your intercompany payables, your intercompany invoices, are they being settled and paid in a timely fashion in accordance with your intercompany payment terms? Are those lending agreements in compliance with U.S. and international tax and legal requirements? And also, do you have the technology infrastructure in place? Or are you heavily reliant on email and Excel and perhaps the manual processes to execute against these intercompany deliverables? Okay. So with that, let me turn over to Jason. Jason, if you want to take over and kind of go through perhaps some of the goals of an in-house bank structure.
Yeah, thank you, Greg. And those are some really good questions to really focus on as we go through this presentation. Now, what I'd like to do, and what I typically do to start off any discussion on changes in liquidity structures, is go over a set of goals. What are you looking to accomplish? So what some typical goals are for when you want to build an in-house bank structure. If you find yourself saying that I'm really looking for a need to control and access my cash, that's something that would really signal to you, maybe I should look into building an in-house bank within my organization. What you normally see after you implement an in-house bank is that you're able to aggregate your funds. You're able to increase your investable cash within the in-house bank structure or any of the participants. They'll be bringing that cash together, which we'll go over how that happens. You'll also be able to reduce your external borrowing. So if you're in need of certain funds in a different currency, you might be able to have more access to that to lend without having to go to an outside institution for it. Also, you're going to gain efficiency. So if you're looking to be more efficient with how you're processing your payments, then an in-house bank structure is also something that you should consider. You'll be able to, with an in-house bank, you'll be able to center your payments into one single organization or one single legal entity. Also, you're able to enhance your working capital management. I had mentioned that you're able to reduce external borrowing, which that makes for a much more efficient use of currencies. It also allows you to create some more natural hedges when you're long in a certain currency and short in a different one. So now a little bit about what you're going to see as you start to set up an in-house bank. An in-house bank isn't something that gets implemented overnight. It takes a lot of work with other groups, and the structure itself is fairly complex, and there's a lot of different parts that usually get added onto it. Now, no in-house bank for an organization is going to be exactly the same as another one. It's not a cookie-cutter liquidity structure that you're going to put in place. It's a few different structures that get combined, and then the benefit is all of these parts working together. It drastically improves your improvement of your liquidity structure. So first off, what you're going to want to do is you're going to want to set up a sweep structure, set up some of your pooling, and you're going to want to take a look at your investing. You're going to want to have a legal entity that's able to facilitate all of this movement of cash, something that everything can sit underneath. So that's going to be really your first step. Now, once you're able to get the sweeps in place, you're able to bring together your cash into a single pool, then you're going to be able to start lending that cash to some of the other entities that are involved with this. That's when you start to see enhancements in your working capital. You're going to be able to start to do FX trading. Now, I list FX trading here. This is going to be more internal FX trading. How can your internal entities fund each other? Next, once you have all of this set up, then you're going to be able to facilitate your intercompany netting. Also, intercompany settlements, any type of loans that you have in place, they'll be able to be processed in a much easier fashion, much more streamlined. Finally, once you have all of this in place, you're able to get what I look at as the crown jewel of in-house banking, which is the most efficient form of payments, which is pay on behalf and collect on behalf of. When you're implementing this external payment efficiencies, that's when you start to see your sweep aggregators slowly start to fade away, because no longer do you have a need for subsidiary receivable accounts or subsidiary AP accounts, because that's all going to be managed through this in-house bank legal entity. So now a little bit about these sweeps and some of the elements that I was just talking about. What you're going to see when you start to set up these set up your sweeps is you are going to first need some sub-accounts. So, well, likely they already exist, but it's best if you start to rationalize them. You start to clean them up. If you have an entity that has 3 or 4 sub-accounts, either have them funnel into a single sub-account or start to direct those receivable accounts into a single account, as well as your payable accounts. Try to rationalize as much as possible. Now, as they move up this legal structure into your in-house bank, you're going to want to try and find out if there's ways that you can have bank-initiated sweeps, or if you're able to have these interbank sweeps done through a Treasury workstation. So there is a certain amount of technology that needs to be invested in order to facilitate this. I know that nobody really has just one bank, but the idea of having an in-house bank is to make it as if you do have one. So when you aren't able to leverage a bank sweep for maybe what I have here is a cross-border sweep from the FinCo or cash pool. Cross-border sweeps sometimes aren't something that's supported by a bank, but you would be able to execute that as in an automated function through the use of a Treasury workstation. You're also going to need to find out when you should be sending those funds. Is it going to be when you have a certain threshold within these sub-accounts? Is it when you're going to need surplus cash? Is it going to meet a minimum at the pool? So you need to start to define these different limits that are going to be used. Next, you're going to want to come up with the different cash pools that you're going to be needing. Cash pools are going to be where you start to aggregate your funds. So as you start to aggregate your funds in these cash pools, what's going to be the use of them? Are you going to need a notional pool? Is it going to be a physical pool? Another thing is based off of the entities that are participating in this. Is it going to be a multi-currency pool? Are you going to need to pool different currencies together into one single pool, or are you going to set up separate single currency pools? Now, a lot of that is dictated based off of how you want your investment structure to be and what functional currencies. If you're working in if you need to hold cash in 6 different functional currencies, a multi-currency pooling option might be the option that you want to look at, because you're going to have some excess in some of these small currencies of just maybe a small portion of what your actual cash holdings are. You're not going to be looking to invest that physical cash, but you're going to want that to be able to be pulled into what investable cash would be, investable currency may be, for that in-house bank's functional currency. Now, I list here complexity because depending on your option for multi-currency and single currency, you may want to have multiple pools, or you might want to come up with overlay of various pools, so a pool that feeds into another one. Or it might be based off of the legal jurisdiction requirements of certain countries that your in-house bank is incorporated into, that different pool options might need to be investigated. Sometimes I've seen some companies actually come up with virtual pools where they don't put this pooling in place at a particular bank, but they manage it through a series of both credit agreements and tracking the balances within the Treasury workstation. So depending on what your pooling needs are for this cash in the in-house bank, that really dictates what type of pool option you're going to need to set up. So this is good and all, but how does this actually look in terms of a structure when you have this pool set up? I had mentioned earlier that you're going to have sweeps set up. Some are going to be bank initiated, some are not. Now, what you're going to have eventually is going to be this single FinCo bank account. This FinCo that I'm listing out here, this is going to be your in-house bank company. So at some point you might have an actual in-house bank company that's established for this particular purpose. If you're not at that stage yet, but you do want to start to move forward with some liquidity structures, this might just be a regional holding company that you have in place already that meets the legal requirements to be able to open up a cash pool on behalf of some of your subs. So when you do this, you're going to have one of your subsidiaries has an excess of AR and AP in an operational account. They're going to be sending funds into what they look at as their notional account. So you'll be tracking the balance of subsidiary 1. as they need cash going through their payroll account, which I've also listed out as the second sub-account here. Funds will sweep into that sub-account to be able to fund their payroll. Next, you have another sub, the sub 2. They have one single account for all of their operations, and being a good subsidiary, they're running at a surplus. So they're able to also add funds to this FinCo bank account. Now, what you'll see as a result of this is you're going to see cash begin to develop in this FinCo bank account. So as we look at the next slide, we're able to see what you're able to do with this excess funds. You're able to invest them. So you're going to now be investing on behalf of just this one FinCo. Instead of having maybe 4 or 5 different companies that are holding investments, you're able to increase the investments at this one company. Now, I had mentioned that one of the goals is you're going to have an increased control of cash. Instead of having maybe some larger subs manage their own investing, as a larger corporate relationship, you're able to maybe help your credit agreements by saying we're investing all of these funds into a bank's investment. That might be able to help your relationship with some of your credit banks. Now, in doing that, you're able to also maybe get some reduced bank fees because you're able to say that we have a consolidated amount of cash within this one investment or within your portfolio of cash management or credit banks. You're going to be seeing increased funds from your cash pooling because you're also doing sweeps. You're going to see cash feeding into this in-house bank from the sweeps, and also cash from lending. Lending is something that's a little bit more complex we haven't gotten to yet. We'll get to in a second. But as you start to have some lending occurring in between your in-house bank and some of your subs, you're going to begin seeing that funds can also increase there as well. So let's take a look at some of the lending options. When you have your FinCo being in the center of all of this cash, you're going to start to have some functional currencies for the FinCo as well as non-functional currencies for this FinCo begin to increase. You're going to be able to then say, well, because we have this cash centered at this single center entity, we're able to lend out to all of these various subs instead of having a sub led to another sub. Now, what this is now being referred to as, I know these terms change throughout the years, but what we're looking at this now as being called a hub and spoke model. You have this single in-house bank, which is actually really the hub. It's the financial hub for your company. Funds will feed into it and funds will feed out of it. Now, this will start to streamline your intercompany agreements because they're all going through this in-house bank. So no longer is it going to be you're lending from country A to country B. You're not lending now. I'm not too privy to all of the country requirements, but if you're lending from Spain to France, you're not going to have to worry about any of those legal agreements because it's going to be, say, you have your in-house bank set up in England, which is a very, the UK is a typical place to have a European-based in-house bank set up. You will then just need to know, okay, so England to Spain or England to France. That's going to be more or less the way that you'll be looking at setting up these financial agreements. Now, trading. Trading is also another form of lending. Now, I know Greg is going to speak a little, and Greg and I are both going to get to 385 and how this comes into play. But if you need to do FX trading, you're going to be long in certain currencies and short in other currencies. Now, your in-house bank is holding more of these currencies than it had before. So rather than having a sub that's long a certain currency that's fairly distant from another sub that's short that currency, it's all going to be centralized in that in-house bank. So you're going to be able to see reduced costs in FX trading. You'll be able to book the deals depending on your technology investment. You'll be able to book these deals in your Treasury workstation, most likely, and it's going to process these deals, send the cash out, and it'll also be able to, again, depending on your technology and investment, it'll be able to make the necessary accounting entries. And that makes things a lot easier when you're able to centralize all of that work, and you also don't need to be contracting with external institutions in order to get those funds. So let's take a look at an example of that. So here we have a entity, happens to be called Kyriba Canada, and it's a subsidiary of Kyriba Finance Company. Now, this Kyriba company it's long $50 million US. So because it has this excess cash, it's just going to, through maybe normal course of the sweep, it might be a daily sweep, it might be a weekly sweep. It'd be nice if every day Kyriba Canada generates $50 million. Anyway, it's going to send those funds to Kyriba Finance Company. Now, Kyriba Singapore has a need for 15 million Sing. Because Kyriba Finance Company now has an extra $50 million on hand, they'll be able to reach out to an external bank, and they'll be able to trade that $10 million US for the 15 million Sing. It now has $40 million US that it'll be able to invest to another external bank. So you're now increasing your relationship with the second external bank, with the Kyriba Finance Company. You're able to get that Sing out the door. Kyriba Finance Company at this point, it's likely that they weren't long Sing, or else they wouldn't have had to trade with that external bank. Had Kyriba Finance Company had been long Sing from maybe another Singapore entity, or maybe receivables in a foreign currency from a different company, it wouldn't have had to go out to that external bank, and it wouldn't have had to have that FX gain or loss from it. So that's an example of how you can really streamline a lot of this FX, or some of this lending, some of this investing. Now, as you can see, there's a lot of different elements to this in-house bank structure that you're going to need to really get in line as you start to plan it out, build a roadmap, and start to really get underway with this. So who is going to be involved in your next steps? You're going to obviously need to get involved. I'm sure that all the Treasury people here, and I'm sure that there's quite a few accounting people on the phone as well, but you're going to need to get involved with your accounting team. You're going to need to understand what current accounting activity you're starting to do already, you're doing already for your current needs, how that's going to be changed in your in-house bank structure. Your financial operations is going to be going through a change as well. So you're going to want to get them on board, let them know what some of your Treasury or finance goals are for this in-house bank, and find out from them where they think that some of their enhancements can go. You're going to need to get in place your ERP team. Now, a lot of times you'll invest into a Treasury workstation and want to do some of these advanced in-house bank structures. Now, you are going to need your ERP team to understand that there are going to be some builds that they're going to need to do as well. In-house banking is very heavy in the accounting, as you're going to need to track subsidiary balances depending on how advanced of a structure you're going to be making. So you're going to want to make sure that you involve them, because the Treasury workstation and your ERP system are going to need to communicate very closely. Corporate and international tax. And your legal team as well. These are going to be two very large players in the structure of your in-house bank. They're going to be dictating different jurisdiction requirements. That's going to also dictate who can and cannot participate through any various structures that you're going to need to have in place if you're going to be needing to open up any new FinCos. You're going to need to discuss with them. Also, the legal team. You're going to need to sign intercompany agreements with all of your participants with the in-house bank. Now, this is going to be something that's subject to the different legal requirements of both the subsidiaries' domicile as well as the in-house bank's domicile. So you're going to need to speak with your legal team about what needs to be in place for these legal agreements. Your banks are going to be involved as well. I think that what I've seen a lot of times is the very, very beginning steps that are typically taken, sometimes even before speaking with some of these other teams, is that the Treasury team will involve their BAM team to go through an account rationalization. setting up an in-house bank, you do need to make sure that that you are working on a set of rationalized accounts. That means that any accounts that are extra, if you have a subsidiary that has 4 or 5 receivable accounts, is it necessary? Receivable accounts are something that are difficult to phase out into a single receivables account. But if it's not necessary, then you really should look to rationalize them. It makes things more cost effective in the long run. And finally, the Treasury team. The Treasury team is typically the center player for establishing an in-house bank. They already have the relationships with all of the other dependent groups, and they'll be able to coordinate the structure, come up with what's going to be most efficient for all teams. They're also typically the one that has the investment in the technology that's going to be used as the interface for this in-house bank. So they'll be involved with coming up with all of the necessary procedures that are going to be laid out, as well as what the plan will be for enhancing their technology to facilitate this in-house bank. Now, as we had spoken about, this is typically something that we see bridge multiple countries. Sorry. So as you're starting to think about who your participants are going to be, you're going to want to think about what it's like to do business in some of these countries. Doing business in Vietnam, Venezuela, Argentina, anyone that has done business in those countries, or China, those are some more difficult countries to get funds out of. So your liquidity structures in those countries are going to be more focused on just those countries. As you start to move out of those countries and you start to relax some of your regulatory considerations, you're going to start to see countries like South Korea, Thailand, Poland, where it might not be the easiest thing to get funds out of. So you might have a manual extension of an in-house bank. These funds these countries you're able to sometimes get funds out of. It needs to be a little bit more manual. You need to have maybe someone in country process some of these transactions. But they can still be considered a participant, maybe a distant participant. Some of your easier countries to work in, obviously Western Europe has always been a fairly easy area to work in. Australia, New Zealand, even though the time zones might be a bit different, being able to send the funds out of those countries, it is a lot easier. So that might be a place where you're going to look to incorporate your in-house bank. Next, we get to some of the U.S. regulations. Now, if you are a U.S.-based corporation that has multinationals, you're going to be subject to some of these recent changes to Reg 385. Now, Reg 385 sorry, I got a little tongue-tied there. Reg 385 is looking to is taking out some of the freedoms that you might have with intercompany lending. Now, as some of these freedoms get taken out, it starts to put in place some restrictions. So when your in-house bank is lending funds to certain subsidiaries, it might be taxed more as if it's a capital or if it's being debt. So, Greg, I'm not sure if you have a couple of points that you might want to make here.
Yeah, sure thing, Jason. I think from our perspective, and of course we interact with a lot of clients, there was a lot of concern around the proposed Reg 385 that was out. There's a lot of papers on that, a lot of concern, a lot of clients got heavily involved with maybe making some changes to their intercompany structures over the summer. And then as the sort of final language came out in October, I think it was broadly viewed as good news, right, that it eased some of those concerns, namely that it broadly exempted the debt that's issued by foreign-controlled corporations or foreign corporations from some of these proposed regulations. But even still, I think from our perspective and what we see here at Kyriba and working with a lot of clients from a technology perspective with our tools to facilitate and manage in-house banks, so that they have that new scrutiny against around intercompany lending, intercompany pooling, right? So ensuring the documentation was reviewed and updated. I talked with certain clients that went to the extent of maybe updating intercompany facility or demand facility agreements, turning those more into services agreements, and ensuring as well from an intercompany standpoint that those intercompany agreements covered things like netting agreements or FX trading and such. So make these more thorough and more compliant from a service offering perspective. Also from a rate perspective, I think there was maybe historically a lot of clients and perhaps some folks on the phone here where you kind of set those rates and set it and forget it, and really spend a lot of time reviewing the credit worthiness of your subsidiaries, reviewing sort of the arm's length interest treatment between the subsidiaries. So I think with the Reg 385 and a lot of that proposed language initially, there was quite a bit of focus around those borrowing in terms, interest spreads, and also around default consequences. Again, getting back to that theme of set it and forget it, ensuring now that there are compliance in place, that companies don't over borrow against an internal facility or a certain amount. I think all of these are good hygiene and good updates and good scrutiny around intercompany pooling, intercompany lending from some of the examples that we've seen with our clients.
Yes, and that's definitely something that I'm not sure if you want to call it a scare, but I think that at first, from when I was having discussions with some of my clients as the proposed language for 385 came out, it was putting in place, it was making people apprehensive. Do we really want to go forward with an in-house bank at this time? So a lot of my clients did put that off until some of these more final 385 language releases did come out. And I think at this point now it's not so frightening to come up with an in-house bank under the new 385 regulations. But I think that, Greg, I think that you brought up a great point. It really does come down to making sure that you update your agreements and you discuss with your legal team and your tax team how to best structure this in-house bank. I think that at first it was something that the 385 was really going to, if it went through with a more strict language, we might have seen a phase out of in-house banking because it would have been more difficult to navigate those regulations. But at this point, I think that we do see a little bit more relaxed language that does facilitate that. So, Greg, do you want to now go into multilateral netting and discuss how this can be another liquidity solution?
Sure thing, yeah, Jason. Yeah, so I guess from this section here, we're going to switch gears a bit. Obviously, stay in the theme of intercompany and intercompany activities, but really, speak a bit more, not necessarily on intercompany funding per se, although there is a component of this, but really around the settlements of intercompany invoices, of intercompany positions. So kind of ease into some of that workflow and where a netting solution, a netting program, can add a lot of value, a lot of efficiency. So let's kind of go through some of these slides here to get started. And I guess as a foundation, and I suspect many folks here in the call are familiar with these terms, but just to be brief here, this is set a foundation that obviously in the course of business, right, in the course of your respective companies and industries that you operate in, intercompany balances are created each and every day, obviously, right? And these are created through natural course of business. Take your traditional manufacturing company where certain product is produced and manufactured in Germany, and that product is then shipped to a distribution center here in the U.S. And that shipment of goods and that invoice obviously creates an intercompany payable due from balances. So obviously, these balances are changing, are updating, are being created each and every day, and they must be settled. They must be paid the same way external invoices, external payables need to be settled and paid. Intercompany also, of course, need to be settled and paid in the same terms, right? Your intercompany payment terms, or maybe service agreements. Back to my earlier point, if there are costs and charges related to intercompany service agreements. So again, having that discipline around the settlement is a theme here you'll help me talk about over the next few slides. Examples of these intercompany balances or positions that must be settled include, as I talked about, your traditional trade payables. So we do see netting, netting technology very common with manufacturing clients of ours and for quite some time. But also other areas that may be a little bit less obvious as far as intercompany positions that can be settled from a netting perspective. So cost share, R&D cost share, employee time, expense, and such. Being able to settle those positions on a timely basis. Compensating adjustments, so your comp adjustments that may arise due to inaccuracies in your transfer pricing. That creates a due to, due from that needs to be settled. I talked about service agreements before, but also other types of positions that, again, as a practitioner that we were able to settle through netting, and certainly clients here at Kyriba that I work with that are able to utilize the netting technology to settle intercompany pay downs or principal movements as part of the netting cycle. The ability to, again, settle, have to settle the capital contributions, dividends, and things of that nature that, again, are intercompany positions that need to be paid and moved from entity A to entity B, as an example. So just a starting point here, I'm sure very familiar to many of the people on the phone here that are operating in either domestic or international operations that have a series and balances of intercompany positions that you may be responsible for managing, or at least your colleagues are responsible for managing. Okay, so what does this mean then from a from a workflow perspective? To the right is your traditional before image, if you will. So kind of lays out a global company that has various sales entities that are out maybe selling various widgets into their respective companies. So you can see my case here of an Acme company who has offices and sales entities around the world, and they're buying goods or widgets from, say, distribution companies. In this case, there's 4 large distribution companies around the globe who, of course, also are buying those goods from a manufacturing company. So you're a very common layout, very simple layout, if I may, as far as getting us started here, as far as the movement of invoices, of goods, and of course creating the payables and the receivables as a result of this activity. So the challenge maybe from a Treasury perspective, and what we see kind of at the before image, is that creates a lot of activity, a lot of payments, a lot of work, a lot of reconciliation to settle those intercompany invoices. So the payment volumes in a structure such as this can really be quite substantial. That equates to larger transaction fees from a bank transaction fee standpoint. Settlement risk, right? Also the ability to move money across various jurisdictions, different central bank requirements. You have that issue of, do the funds arrive on time? Are they caught up in some sort of intermediary bank? So settlement risk and those challenges that we all face in Treasury. And also the related FX costs, whether they be situations where you're just doing an FX payment and taking the bank rate, which can be quite expensive, or whether you're doing a host of spot trades or FX, competing those trades that can be not just expensive perhaps, but also time consuming, which is a nice segue into the inefficient use of resources. There's a lot of manual effort here, clearly, to settle and enter these payments on a timely basis. From a clearing perspective and a cash application and clearing those intercompany positions, both from a receivable standpoint as well as a payable standpoint, that can be very time consuming and certainly error prone, both from a geo-posting, but again from a payment aspect as well. And there's also, I think, maybe this is, I would argue, the most important area, and for everyone here in Treasury, we certainly understand the implications from a tax standpoint and ensuring that we're we're selling these invoices on a timely basis, right? So from a tax and legal standpoint, if they're not settled, right, if we're not settling these in accordance with our payment terms, this can really be quite a severe issue, right? So these could be either turn into an intercompany loan, an inadvertent intercompany loan, or be viewed from a tax perspective as a deemed dividend or capital contribution, which then exposes us to Section 956 income. So very substantial penalties here, obviously, from a U.S. tax perspective. This could be taxed at your 35%, for essentially an intercompany lending or a capital contribution if these intercompany payments from a CFC to a U.S. subsidiary aren't being settled within the intercompany payment term. So a lot of I would say severe, P&L and economic risk here if these things aren't settled on a timely basis. The payment costs, the FX costs I talked about before, and the geo-posting as well could be a compliance issue in addition. Okay, so clearly, a lot of manual work here, a lot of complexity. So what does netting do for us? How is a netting application, a netting program, okay, how is that going to add value and really simplify this? So in the next slide, I have here a view of how that in-house bank company, so tying it back to a lot of the commentary that Jason took us through here in the first half of the session, how that FinCo, that financing company, which also could be the in-house banking company, and I'll go back to that in a moment, how that entity or that netting agent, right, can really be set up to facilitate the settlement of these intercompany payables across all the various companies. So compared to the previous slide where we had all these various companies, sales entities, distribution companies, manufacturing companies, all sending money across the world to settle those intercompany invoices. Instead, we can run a netting algorithm essentially, right, and take all these payables and receivables and net these into one balance. And the next slide will give you an example of this. Net that into one balance that respective company code, that distribution company or sales entity, what their obligation is to settle with that netting company, with that netting agent. So in my example here, I have an Acme netting entity, which is also my in-house bank entity, where they are going to be the facilitator of these settlements. So essentially the zero-sum game, okay, but having an efficient workflow where you have a centralized company who is facilitating the payments and the receipts across all the various company codes. So what that means is you're able to drastically reduce the physical payments. Clients that I work with, and even as a former practitioner who ran these programs in Treasury, we were able to reduce literally well over 1,000 intercompany invoices down to 7 payments per month. And I'll kind of go through the next slide as some of those considerations of companies perhaps that can't settle through an in-house bank that you still need to physically settle. The takeaway is whether it's selling through an in-house bank, meaning it's a intercompany posting, or there's a one payment being settled per company code, it's drastically reducing the number of physical payments, which is lowering the bank fees. It's also going to eliminate the settlement risk, right? So ensuring that the money is being applied and settled. We're not as exposed to intercompany large wires going across the globe, so it reduces that settlement risk. Also ensures that discipline around settling the invoices in a timely fashion, avoiding that repatriation tax under 956 and any other sort of tax restrictions that we might be otherwise exposed to. Also provides a lot of reporting ability, very transparent reporting from the intercompany invoices that were paid, that were settled, that helps not just on the, you see the next bullet there, on the accounting and the geo-posting and reconciliation standpoint, but also for tax and also for kind of ongoing inquiries perhaps from your internal auditors, external auditors, again tax, that you can clearly show the intercompany balances that were paid, that were settled through the netting program. Okay, and also from a currency standpoint, Jason stressed this earlier on. I'll just repeat that. Through an in-house bank structure, in this case through a netting program, you're able to consolidate those exposures. So you're not doing one-off trades and having to buy or sell that same currency pair for several different legal entities, but rather able to aggregate that into a net exposure and trade that from that netting entity, from that typically that FinCo company. Okay. So as I mentioned, I wanted to share here a brief example. I know on the call here a lot of us are practitioners and accounting backgrounds and whatnot, so it's always interesting. Just a very simple screen here, clearly going through a netting statement. But here's an example of that entity where I have a netting participant who, a BV entity who has payables and receivables to different counterparties. So I can see I got that payable of Euro 132 to my German affiliate and the UK company. I have some receivable amounts here from my Canadian entity, from my US counterpart. So you can see the various rates that are applied and helping with that consistency of applying a netting rate across all these intercompany positions. And also you can see in this case, instead of having 7 different transactions, seven different intercompany payments and transactions that need to be manually processed and settled, we're netting this now into one physical transaction. Or in this case, if my BV company is a participant within my FinCo, within my IHV company, it can simply just be a posting, right, to my intercompany balance, so to my in-house bank balance. There's no wire, there's no payment involved at all, right? So there's, again, a lot of efficiencies here that a netting program, that a netting technology can really facilitate from a productivity perspective. Okay. So from a consideration standpoint, similar to some of the examples and some of the talking points that Jason went through from a in-house bank structure and collaborating with the various internal stakeholders and pertinent individuals. The same is true with netting, right? So we have to involve the various counterparts to ensure that we're involving the right entities and we have the right processes and infrastructure in place. Accounting is clearly a main one. This is going to be a benefit for accounting. So if it's a program that Treasury can champion, that can promote from a cross-functional benefit perspective, I think this is a great cross-functional win that Treasury can really contribute to the to the corporate accounting team and local accounting teams as well. So they're of course responsible for reviewing these balances, reviewing these intercompany positions, and again reconciling these. So through a netting program, it does simplify, it facilitates an easier settlement and reconciliation of these positions and intercompany balances. From another consideration is on the operations of the ERP teams, right? So being able to, in many cases for our clients, integrate directly into the ERPs, plural, right? So it could be several different ERP packages or several instances of an ERP package to integrate those prior month-end balances and run those through the cycle. So some effort there involved to ensure we're grabbing the right balances, or that you're integrating the right month-end balances directly from the ERP. That's another consideration. From a tax standpoint, corporate international tax, similar to the points earlier on the in-house bank considerations. Same is true for netting programs. So there are going to be certain entities, certain legal entities that cannot participate in the netting program. From my experience, I will say though, I think there's more opportunity to involve companies into a netting program that may not be able to be involved in an in-house bank structure. So there's some additional upside there, but still it's a very important consideration to ensure there's no central bank or local restrictions or regulations that prohibit certain company codes from participating in the netting program. Documentation is still important, similar to the in-house bank discussion, where drafting the netting agreements, the terms and conditions, the service agreements that we spoke about, that's going to be a requirement where your legal department should be consulted. And then also from Treasury, everyone here in Treasury, really executing the program, right, and ensuring the netting cycle is process is facilitated, and doing various reporting KPIs to ensure that the company codes are entering their payables, that they're matching their payables, and going through that sort of disciplined process. And from a settlement aspect, making sure the currencies and the right accounts and the currency exposure is being managed properly, and those internal external trades is also being processed.
Now, Greg, there is one thing that I would like to actually add to that you made a point about. You had said that that you might be able to see more corporate entities participate in the netting than would be able to participate in the in-house bank. With both structures, you are able to incorporate you have your basis of participants in the in-house bank, but then you could also add into the netting, utilizing both solutions, add in any of those more fringe entities as well, and they can participate in that. You'll have more efficiencies with the in-house bank participants, and you might not be able to the same level of efficiency. You might need to process certain payments outside of the in-house bank for those more fringe netting participants. But you could still utilize both structures, and you'll see a lot more benefits putting both of them together.
Yeah, that's a great point, Jason. That actually a question came up on the board already on that. And I think it to be very clear, your point is spot on in the sense that these are two separate programs, right? You have your in-house bank, your internal demand facility agreements, and the intercompany agreements from an in-house bank standpoint, but you're also going to have agreements and a program that's specific to the netting activities that FinCo company or that Treasury agent are going to be providing. So you're absolutely right, Jason, that there's I think additional opportunity to involve those company codes. I know there are still some restrictions even with netting, but I think it's less stringent, and you're able to involve more companies, more global companies into the netting program to facilitate that net settlement and the efficiency that we spoke about. So it's a good clarification, and I think addresses some of the questions here on the board. Good. Yeah, so in the last few minutes here, and that we want to leave a few minutes for a summary and for questions. But from a technology standpoint, I've covered this a bit. I know Jason had some commentary as well around the treasury management system. But technology is going to be an important component here, whether it's your treasury management system or other technologies you might be utilizing. And I think as a theme, obviously, as working in technology, a theme that we always stress is having it simple, right? Having a simple technology, something that can be easily adopted across different company codes, different users. In many cases, these are not going to be Treasury users. They're going to be your accountants, your chief accountants in certain countries, your corporate controllers, where from a going back to the in-house banking area, where they can quickly run their intercompany in-house bank statements, or where they can maybe request funding if they're not part of a automated cash pool, but perhaps they bank in a different location or a different bank that's not the same bank as your FinCo bank, the external bank, that they can go ahead and request that funding and go through that workflow to request intercompany funding, request or advise on intercompany deposits in a very simple way, and then have all the reporting and downstream benefit that we talked about from a workflow standpoint. From a netting aspect as well, right? Having that workflow where the accountants, the controllers can quickly enter or upload or integrate their prior month-end payables into the technology and run the algorithms to generate the netting statements. So the technology portal is going to be a big component of this. Also helps with the various compliance reporting, right? Again, measuring against perhaps intercompany loan agreements, max borrowing amounts, the arm's length interest treatment that needs to be charged and such. Technology can play a vital part here in the automation and even measure against things such as target balancing or other KPIs that you might want to enforce as a good discipline and a Treasury scorecard with your various subsidiaries that are participating within these programs. And finally, yeah, go ahead, Jason. Yep.
Sorry to cut you off, Greg. But one of the things that I've really found is a great way to come up with what reporting you're going to need out of your technology solution is when discussing and planning out how you're going to be setting this up, understand from any of the participating groups in this, the accounting teams, the legal teams, the tax teams, what it is they are going to in turn be reporting on. From there, you can build your basis of reports, and you'll find out what you do need to be reporting on. So where you might need to have those individual invoices being reported on for one group, it might not be necessary for another group. So understanding that going into the build of your technology and going into the build of your planning, maybe putting that in place in the requirements will also help you down the line. Now, obviously, there are going to be some reports that pop up that as such efficiencies really get around, you're going to want to see other people are going to want to see more out of it. And you could, some of those points, you could usually talk to some colleagues or seminars like this where we're able to help you along with some of those additional reports. But really getting your base set of reports underway is going to involve all of the groups.
Yeah, it's a great point. It's a great point, Jason. I think with technology, obviously, it enables a lot more reports, new reports, and new insight into the business, into the intercompany flows, into better practices around. We talked at the very opening about those questions, right? Optimizing those with the right target balance for your various entities. And now you have that data and can make the informed decision that set KPIs and hold your various subsidiaries accountable. So I think your points are excellent, Jason, in the sense that it does add value to all the various groups and subsidiaries and the participants of these programs. Okay. Good. So kind of moving on here, I'll kind of gloss through this slide, just some examples of statements and reporting and workflow that we talked about before from a technology standpoint. But I think, in summary, in the closing slides here, and we'll leave a few questions, time here for the questions that come across. I think, to see the big picture and going back to some of those opening questions that we want to reflect upon, our roles here in Treasury is to ensure that our internal customers, our internal entities that we call them, that they have the adequate liquidity, that they can be successful to fund their local operations, that there's adequate liquidity to fund those business units, your corporate operations, and also be able to have the right liquidity to fund your corporate strategy, your capital allocation strategy, whether that's buying back shares, whether that's M&A activity, paying down debt. So liquidity, cash flow, free cash flow generation are all critical things in Treasury that we're tasked with. And through a lot of the mechanisms here with an in-house bank, especially where it creates a form, it creates a mechanism to mobilize cash more effectively. It creates an opportunity to consolidate that cash at regions or at certain company codes to help you execute against these deliverables that we have in Treasury. So from a big picture and a broader business value that we can contribute to our respective firms, the downstream benefit of these intercompany liquidity and in-house bank techniques is really, really important as we execute against our core jobs here within Treasury. The in-house bank, also from an economic standpoint, it saves a lot of costs from a say borrowing perspective. Jason hit that point earlier on, where alleviates the need to go to the external markets to borrow funds locally or have local credit facilities in place to fund sort of short-term gaps or overdrafts within a quarter, within a month. Your subsidiaries are now able to request that funding and get that liquidity, get that funding through your in-house bank, which is obviously a lower cost, a cheaper form of financing versus external financing. Right? And then we said as well, Jason mentioned that of course we appreciate there's going to be multiple banks involved, right? So you're not going to have the same bank most likely in all regions of the world, all locations of the world. So an in-house bank helps to sort of normalize that, where even if you bank different banks in different geographies, you can still use the in-house bank as that common tool to get the automation of funding, get the target balance benefits to ensure those accounts are funded and are maintained against a target balance that you set within Central Treasury. And I think our final slide before we open up to questions here is again on the netting side. I know we just covered this, but netting again is a separate program, right? But still in the theme of today's session, really discussing around intercompany best practices. Helps us to settle our intercompany invoices timely and efficiently. Helps us to reduce bank fees and FX costs that we talked about. Eliminate the risk of settlement cross-border payments and multiple geographies and time zones. From experience and from my perspective, I think certainly the tax benefits and the discipline in ensuring that those intercompany payables are being settled in a timely fashion to ensure we're not exposed to any adverse or negative tax implications is vital importance. Helps also from a consolidation of currency exposure that we talked about, and also drives automation and drives better productivity down to the clearing and application of cash from clearing those intercompany balance back to the GL. And then with both themes here today, whether it was the in-house banking discussions or the netting discussions here, I think it was clear that these are very much a cross-functional investment and working with your colleagues in the various finance teams, tax, local finance, legal teams, and so forth, to ensure that you go through the right due diligence, that you have the right infrastructure in place, that the legal entity, the financing company, or the in-house bank company is structured properly, that you've reviewed the local restrictions from a geographical standpoint of what companies can participate within these programs, in-house bank or netting, and also the arm's length interest treatment, documentation, and some other topics that we discussed, whether it be 385 or just other best practices around the treatment and the structure of the intercompany engagements. And then on the technology front, again, we covered that a lot through the session, but clearly technology can be a great resource and a great tool to execute and to facilitate, monitor, and maintain these programs from an in-house bank and from a netting standpoint. Anything else you want to add, Jason, before we address some of these questions?
No, I think that you summarized it pretty well, and I do want to be cognizant of the time. 2 minutes left to get to the questions. So we do have our first question from the audience is, how do you determine the FX rate to apply to an internal FX trade? Now, what I've seen from some of my clients, what they do is typically one of two things. They will either set a predefined rate premium that goes on top of a certain currency pair, and they would dictate that in their system. So whenever the trade is requested, it defines whatever the market rate is plus this predefined premium. You typically do need to define this premium because the in-house bank does need to be generating some sort of service fee. From there, you could do either that one or another type of process that I've seen some of my clients do is they'll actually go to market for the trade. They'll see what that trade would actually be priced at on the market, and they'll pick whatever the best rate is, and they'll use that as the execution rate. I'm not sure, Greg, if you have anything else that you'd like to add to that one.
No, I think it's a good summary. I've seen different approaches as well, but I think you summarized it well on how that can be applied. So yeah, whoever asked that question certainly would be happy to go into further detail and provide some examples if that would be of use. The second question here, I'll take that one, Jason, and certainly add your commentary as well. I think we tried to address it kind of throughout the session, but let's address it again here. I think it's a great question to be very clear. It says, how would we sum up the fundamental difference between an in-house bank structure and a netting program, or do we consider them to be complementary? Again, to be clear, these are two separate programs, right? So from an in-house bank, this is a mechanism, or it's a program, all right, that allows for internal financing. So you set up a financing company or have a company that's established as an entity that can lend to various subsidiaries or participants with the in-house within that structure, or take deposits from those companies. So it's that mechanism to consolidate funds across the various company codes, whether it be domestic or international, and facilitate that intercompany bank structure, right? Netting, when we have clients here that run netting programs that do not have an in-house bank. Likewise, we have clients that have in-house banks that don't run a netting program. So they are certainly separate, but the opportunity here is to be able to integrate them. So from a netting standpoint, as we discussed, it allows you to establish that netting agent or that netting company, which in many cases, if the client is running an in-house bank, it's going to be that same entity, that same company. And that netting company acts as a facilitator, as an agent to settle the net payable, receivable that the various netting participants accumulate through the netting cycle, right? So they are separate programs. They have separate agreements, separate sort of objectives, but can certainly be integrated and combined to add some efficiencies, with netting such that you don't have to even have a net payment, but simply adjust your intercompany loan balance if that netting company belongs to an in-house bank structure. Jason, I don't know if you want to also add some commentary there as well to further clarify or add some different color points.
Yeah, well, I typically look at an in-house bank as something that's able to facilitate lending, something that's able to build efficiencies with external payments, and it's also a way to consolidate investment. Netting is more a way to settle intercompanies. So looking at it from those two perspectives, an in-house bank can also, to Greg, to your later point, an in-house bank can be used to facilitate the settlement of those intercompanies as well, but the in-house bank structure is a separate structure from that netting process. They can be incorporated together, or they can be maintained separately.
So Greg and Jason, I'd like to thank you for answering those questions. We have a few other questions that have just come in at the top of the hour, and unfortunately we're going to have to respond to those folks on a one-on-one basis and provide that information later. So thank you everyone for taking the time to join our webinar today. We hope it was helpful for you. And just so you know, we'll also send links in the email that you get that will have a link to the recorded webinar as well as the slides. We have a really good success story with one of the Kyriba clients, which is Shalhoub Group Treasury, and you can read more about that. We also have a blog post on Kyriba.com, which talks about why treasurers should adopt multilateral netting. And of course, if you have any questions, you can always send an email to treasury@Kyriba.com, and we look forward to chatting with you on upcoming webinars. Have a great rest of your day.